This video is about oligopoly, which is another type of market where firms have market power. So again, we'll compare oligopoly to perfect competition. In an oligopoly, there are a few sellers, not many as in perfect competition, but also not just one as in monopoly. So a few can mean anywhere between 2 and 10 sellers who have a majority of the market share. There may also be some smaller competitors in the market. Oligopolists may either all sell identical goods or differentiated goods, so that just depends on the market. There isn't free entry and exit into this type of market, but there also aren't strong barriers that restrict more than one firm from entering the market. Entry can be difficult because of weaker versions of the market barriers we talked about for monopoly, but it is possible. And there may not be perfect information in this type of market. So specifically, firms do tend to know what the other firms are actually doing, but they don't necessarily know what they're going to do before they do it. And we'll see why that's important in a minute. Some examples of markets that are oligopolies are the market for telephone and internet services in Canada, where there are 3 to 5 major players depending on which province you're in. The market for airline flights in Canada, where there are 2 major players that dominate the market, Air Canada and WestJet, along with some other smaller competitors. And the global market for breakfast cereal, where there's actually 4 large competitors, Kellogg's, General Mills, Post, and Quaker Oats, which together have 86% of the market share. Unlike with the models of perfect competition and monopoly, there's no one single formal model of oligopoly. Instead, there are several different possibilities for how oligopolistic firms might choose to behave. So each firm in this type of market has some market power, so they can choose their own prices and quantities. We always assume that they want to maximize their profits, but how they can best do that actually depends on the decisions that the other firms in the markets make. So here's an example of how that works. Here we have a market with just 2 firms, Firm 1 and Firm 2. So for example, you might think of Coca-Cola and Pepsi. Each firm has to decide how much to charge for its product. So first, suppose that both firms are charging a high price for their product in order to make as much profit as possible on each unit that they sell. In that case, both firms would make a moderate profit. But then suppose Firm 1 decides to lower its price to try to attract customers away from its rival. Its outcome will depend on what Firm 2 decides to do in response. If Firm 2 keeps its original high price, Firm 1 will get all the customers and therefore will make more profit, even with a lower price, while Firm 2 will actually make a loss. That actually makes it unlikely that Firm 2 will decide to continue charging a high price. Instead, Firm 2 will charge a low price. But if both firms charge a low price, both make less profit than they would if both charged a high price. So if you were Firm 2, what would you decide to do? Suppose you believe that Firm 2 will charge a low price. Then you're better off also charging a low price so that you don't lose customers. But if you believe that Firm 2 will charge a high price, you're still better off charging a low price so that you can steal their customers away. So either way, you're going to charge a low price. And the same analysis holds true for Firm 2. So the most likely outcome is for both firms to charge a low price, even though they're worse off than if both charged a high price. This kind of situation is what we call a price war. Each firm tries to undercut its rival to gain a higher market share, but as each firm responds to its rival's price cut with its own deeper price cut, eventually prices are driven so low that each firm is just breaking even and the price can't go any lower. So that kind of outcome is very good for consumers, but it's not so good for the firms involved. Now, a price war happens when firms are competing against each other to gain market share. But suppose that the firms instead could agree together that they will both charge high prices and that they won't try to undercut each other. This would put them both in the bottom right cell, where they're both making moderate profits and doing better than they would in a price war. This kind of strategy is called collusion. There are actually several different types of collusion. One kind is the formation of a cartel. So a cartel is where firms get together and formally agree to lower their production in order to drive up prices. So essentially what they're doing is agreeing to act together as a monopoly. OPEC, the Organization of Petroleum Exporting Countries, is a cartel. Each of the member countries which have nationalized oil production agrees to a production quota that keeps oil supplies low and keeps prices high. In most industrialized countries, including Canada, cartels are illegal. So countries are allowed to form a cartel, but companies within most countries are not. Companies are not allowed to limit competition because it's bad for customers who have to pay high prices. Another type of collusion is price fixing. So this is where firms don't have formal production quotas, but they still cooperate to all charge high prices instead of undercutting each other. Price fixing can be either explicit, where companies actually agree together formally to charge a high price, or tacit, where they don't agree, but they just decide to charge the same price as their competitors. So if you notice that gas stations in an area are all charging the same price for gas, that's usually not because the owners all called each other and decided to charge the same price. It's usually due to tacit collusion. Each of them continues to charge the same price that their competitors do. Explicit price fixing is illegal, but tacit price fixing may not be. The government has to prove that companies actually have an agreement in order for them to prosecute the firms for price fixing. Another form of tacit collusion is price leadership, where one dominant firm in an industry sets prices and then everybody else follows them. So for a long time, Air Canada played that role in the Canadian airline industry. When Air Canada raised prices, everyone else would too. When they lowered prices, so would the competitors. So collusion can be hard to sustain. Even when there's an agreement between firms to raise prices, each individual firm has an incentive to break that agreement and undercut its competitors to temporarily earn a higher profit. And even OPEC, which is perfectly legal, has suffered from a lot of cheating over the years, which has tended to cause oil prices to be lower than they would be if OPEC competitors were actually following their production quotas. But we also know that some oligopolies have been successful in maintaining high prices for long periods of time. So for example, internet prices in Canada are much higher than in many other countries due to the lack of competition in that market. So just to sum up the possible outcomes in an oligopolistic market, if firms end up engaging in a price war, we actually get the perfect competition outcome. Prices are driven right down to marginal cost, the quantity sold is high, and there's no inefficiency. But if firms end up colluding in some fashion, we get something closer to the monopoly outcome. And that how close we are to that outcome depends on how effectively the firms collude. So prices tend to be high, quantities traded are low, and the market's inefficient because of the deadweight loss that comes from selling a lower quantity compared to perfect competition. And in fact, oligopolistic markets can be even more inefficient than monopolies because they don't even benefit from economies of scale. So this is why the Competition Act bans collusion, including explicit price fixing and the formation of cartels, and sometimes blocks mergers of companies that would result in oligopolies. All of this is to try to avoid those kinds of undesirable outcomes that result from collusion.